You sell gold to get the dollars. They start selling gold because it's going down. You're in the wrong market because that's how commodities trade and that's how gold trades. I'm not saying gold's going to go to $3,600 an ounce. You can act as a dealer to the Fed. When they want to buy or sell securities, they call you. There are only about 20 names on the list. So when they want to print money, basically expand the money supply, I always point out there's M0, M1, M2. The Fed doesn't even know what money is because they've got vanilla, chocolate, and strawberry. They got three flavors. And so Goldman will deliver the 5-year notes to the Fed, and the Fed will pay for them with cash. And the cash does come out of thin air. The idea of the stimulus is nonsense. The commercial banks can print money the same as the Fed by just debiting my bank account. But that money, that's M1. When the Congress says, we're going to have a $1 trillion COVID stimulus package or $1 trillion. When the government, the Congress, and the White House do that, and they push $1 trillion of spending, government spending, into an economy that's already overheating, that can cause inflation. Where are you going to get the dollars? Well, you sell gold to get the dollars to buy the oil. You might like the gold, unless people selling gold don't. The big hands or the strong hands anyway, they don't hate gold, but they need the dollars to buy oil to keep the lights on. So that is a very simple explanation for why gold started to go down. If you look at an oil chart and a gold chart, you'll see they're inversely correlated over the last 6 months. So the beginning of the decline was not that people hate gold, it was that they were selling gold to get dollars to buy the oil. Okay, so now once that begins, what happens? Well, you've got leveraged traders. They hit stop losses. So they've got to close out their positions. So they're selling more gold on the futures market to cut their losses. That puts more downward pressure. Now here come the commodity trading advisors. They're just trend followers. They don't care if it's soybeans or gold. They're like, hey, I'm going to jump on the bandwagon. So they start selling gold because it's going down. And then you hit more stop losses. So it feeds on itself. So there's a very easy to explain dynamic. So you need a trigger, which was sell gold to get dollars to buy oil. But then everything else just almost happens automatically, like, start a small avalanche. The next thing you know, the whole mountain's collapsing. So we are where we are. Now, what does that mean for the future?
Gold and silver have turned increasingly volatile, leaving many investors wondering whether this is the start of a bigger decline or simply another correction. While headlines focus on falling prices, best-selling author and investment strategist Jim Rickards believes the real story is happening beneath the surface. In this interview, Rickards explains why liquidity, inflation, and investor psychology, not fear alone, are shaping today's precious metals market. He also shares why he believes disciplined investors should focus on the bigger picture instead of reacting to every short-term price move. So, is this correction a warning sign? Or could it be a rare opportunity most investors are overlooking? Let's find out.
Well, let me see, it was a while ago, about 14 years ago, I was in the Dominican Republic and I was talking to Jim Rogers. Now, Jim is, probably the greatest commodities trader in history. He's legendary, co-founder of the Quantum Fund with George Soros. And at the time, I'm sorry, it was a little bit later than that. It was around 2014, but gold peaked at $1,900 an ounce in August 2011. It bottomed at $1,050 an ounce in December 2015. So you had a 4+ year bear market. And I was talking to Jim kind of in the middle of that decline. And I just said, we were having drinks down in the Casa de Campo. I said, Jim, what do you think? He said, well, I own gold. I'm not selling. I'm just going to sit tight. But then he said something I'll never forget. He said, no commodity goes to the moon without a 50% drawdown along the way. And if you're not prepared for that, you're in the wrong market because that's how commodities trade and that's how gold trades. Well, I said, okay. So I took that and I said, because you got to pick a base if you're going to do percentage increase and decline. So I took a base of $250 an ounce in December 1999. That was the end of the long bear market from January 1980 to 1999. I said $250 an ounce. So I took $250 an ounce up to $1,900 an ounce. That was August 2011. I took half of that, subtracted it from the peak to get the bottom, according to Jim Rogers, and I came out with 1070. and it bottomed at 10.50. I mean, he was like right on the money, but he told me this in advance before it happened. So I was like, okay, nice going, Mr. Rogers. You got it right. But it was a 50% drawdown, and then it turned around, and then it went up to over $5,000 an ounce just a couple of months ago. Now, in fractal mathematics, there's something called scale invariance. And what that means is that if I give you a 1 week chart of the stock market and I give you a 10-year chart of the stock market and I take away the dates and just show you the charts, they look the same, meaning patterns repeat themselves at different scales, different indices, different time frames, but the pattern repeats. So let's take Jim Rogers' rule, which he was spot on, and apply it to today. Well, we got to pick a base. I picked, I think around 1850, which is a few years ago, up to 53.55. So here's my base. Here's my peak. Take half the difference, subtract it, comes out around $3,600 an ounce. Now, I'm not saying gold's going to go to $3,600 an ounce, but seeing it go to $3,900 an ounce and now around 4,000, like, yeah, that's how it goes. And if you don't like it, you're in the wrong place. But what it also means is that we're at the bottom of that cycle, at or near the bottom of that cycle, and we're paused for, as Jim Rogers put it, going to the moon. So I'm standing by my $10,000 an ounce forecast, late this year, sometime in 2027. We'll see is the exact timing, but, kind of intermediate term forecast. But that would be completely consistent with a drawdown and then a major bounce back, as Jim Rogers described, as the data supports. So yeah, this is a very good entry point. So how does the Fed, and the Fed does print money, there's no question about that, but what kind of money? And how does the Fed print the money? Well, the way they do it, they have an open market desk at the Federal Reserve Bank of New York, and they deal with certain banks and only certain ones. There's a list. The names on the list are called the primary dealers. But that's not even a license. It's a relationship. But if you're a primary dealer, what it means is that you can act as a dealer to the Fed. When they want to buy or sell securities, they call you. There are only about 20 names on the list. It's not like 200 banks or whatever. I was on the executive committee of one of the primary dealers for over a decade. I talked to the Fed every day at that time. But what it means is that when the open market desk at the Federal Reserve Bank of New York wants to buy or sell securities, they call your firm or one of these other firms. So what do? So when they want to print money, basically expand the money supply. And when we say money supply, we're talking about M0. I always point out there's M0, M1, M2. The Fed doesn't even know what money is because they've got vanilla, chocolate, and strawberry. They got 3 flavors, so they're not even quite sure. But what the Fed prints is M0, so-called base money. So how do they do it? They call up Goldman Sachs or Morgan Stanley or Citi, and they say, offer me 5-year notes. And the trading desk at Goldman says, okay, here's our offer. Fed says, done. Shoot them in. So Goldman will deliver the 5-year notes to the Fed, and the Fed will pay for them with cash. And the cash does come out of thin air. That is money that the Fed just says, hey, here it is. But what does my example, what does Goldman Sachs do with the money? They give it back to the Fed in the form of excess deposits. Remember, the Fed is a bank at the end of the day. So when the Fed prints money, they buy securities. So they're increasing the asset side of the balance sheet, but the dealers are giving the money back to the Fed as a bank deposit at the Fed. And so they're increasing the liability side. So they're expanding the balance sheet. But that money is what we call sterilized. It doesn't actually go anywhere. That money does not get lent. It does not get spent. It doesn't drive the economy. The idea of the stimulus is nonsense. That's just not true. If somehow in an alternate world there were a shortage of reserves, maybe, but the fact that they're called excess reserves tells you all you need to know. There are trillions of dollars, trillions of excess reserves on deposit at the Fed. So does the Fed print M0? Yes. But it goes back to the Fed as excess reserves and doesn't do the economy any good. There's no stimulus. There's no inflation coming from it. It's an accounting exercise. Okay. Where does the money come from that does drive the economy? That does not come from the Fed. It comes from commercial banks because Citibank or, JP Morgan, Bank of America can do the same thing as the Fed. And how do they do it? Well, I go in, I say, I want to take out a loan. And they say, okay, here's a loan agreement. You're approved. Sign the promissory note. I give them the note and they put the money in my account. Where does that money come from? it also comes out of thin air. In other words, the commercial banks can print money the same as the Fed by just debiting my bank account. But that money, that's M1, a different kind of money, different flavor, if you will.
Jim Rickards believes the recent decline in gold wasn't driven by investors losing confidence in the metal. Instead, he says a global liquidity squeeze forced institutions to sell gold to raise U.S. dollars as energy costs climbed. That initial selling triggered stop-loss orders, leveraged liquidations, and algorithmic trading, turning a normal correction into a much sharper sell-off. Rickards says this is nothing unusual for commodity markets. Drawing on legendary investor Jim Rickards' experience, he explains that major commodity bull markets often go through deep corrections before moving to new highs. In his view, today's volatility doesn't necessarily signal the end of gold's long-term uptrend. It may simply be part of the normal market cycle. Looking at the broader picture, gold and silver continue to be influenced by geopolitical uncertainty, central bank demand for gold, inflation concerns, and changing interest rate expectations. Silver remains especially volatile because it serves both as a precious metal and an important industrial commodity. Rickards also argues that investors often place too much emphasis on the Federal Reserve alone. He believes commercial bank lending, government deficit spending, money velocity, and investor psychology can have an even greater influence on inflation and the broader economy. His message to gold and silver investors is clear. Don't let short-term volatility drive long-term decisions. Stay focused on the underlying fundamentals. Recognize that corrections are a normal part of commodity markets, and avoid making emotional decisions during periods of uncertainty. So what does all of this mean for investors going forward? Let's wrap it all up.
Now, that money actually can drive the economy because I sign the note, I get the loan, the money's in my account. Now I can hire people, I can invest in fixed assets, I can do development, I can do whatever I want with the money. But the point being that that money printing counts. So Fed money printing is irrelevant. Stop. The Fed's almost irrelevant as an institution. They have the worst forecasting record. They get everything wrong in terms of their modeling, and their money doesn't count. So everyone likes to talk about it on CNBC or whatever, but you can almost skip the Fed. Commercial banks, no. Commercial banks, they create the money that actually drives the economy. Now, by the way, there's another source of money that does drive the economy. It's not monetary policy, it's fiscal policy. In other words, when the Congress says we're going to have a $1 trillion, COVID stimulus package or a $1 trillion Build Back Better, and Trump did $1 trillion in his first term, and then Biden and Pelosi did $2 trillion. It's like, I'll see your trillion and raise you a trillion of spending, deficit spending over and above the baseline deficit. We had a baseline deficit of $1 trillion, and then Biden and Pelosi put $1 trillion on top of that in 2021, and then another trillion in 2022. Remember the August 2022, the Inflation Reduction Act? All it did was it caused inflation. It didn't reduce anything. And it was really the Green New Scam in disguise. But the point is, when the government, the Congress, and the White House do that, and they push $1 trillion of spending, government spending, into an economy that's already overheating, that can cause inflation. It can be stimulus up to capacity, but once you exceed capacity, it's just pure inflation. So the Fed doesn't matter, but deficit spending does, and bank money creation does. So, and that bank money creation, as I say, is an M1. So that's the money to watch if you're trying to figure things out. Now, to your point, Vladislav, you talked about velocity. Well, what is velocity? It's the turnover of money. Basically, it's GDP divided by the money supply, meaning how many dollars of GDP do you get for each dollar of money in the system? And again, we're talking about M1 or maybe M2. So let me give, not to get too geeky with the math, let me give a very simple example. So let's say the bank gives me $1 and I go, $100,000, whatever, and I go and I buy gold and I put it in a vault. That money has velocity of 0. It didn't do anything. I converted it into gold and I sit on it. I don't do anything. Let's say the bank gives me money and I go out and I hire somebody and I pay the person. And then that person goes out to a restaurant and buys dinner. And then on the way home from dinner, the waiter takes an Uber to get home. Well, that money has velocity of three because you got the wage, the dinner, and the Uber. And again, on and on and on. Obviously, it's more complicated than that. So the point is, if I just put the money in gold, I'm not against gold, by the way, I recommend having some gold, but just to be clear, but if I put it in gold or just sit on it, velocity is at or near zero. If I spend it or invest it and then the recipient spends it, invests it, et cetera, then that can have a multiplier of two or three or four, or it can be quite high. So that's really what counts. Now, velocity has been declining for 26 years. It was around 10 or 11 in around 2000. Today, it's down to barely over one. Is kind of well, it's about two actually. But the point is, all the money printing in the world doesn't do any good unless the turnover is there. And this is what Milton Friedman missed. The quantity theory of money is, MV equals PQ, where, PY rather, where M is the money supply, V is the velocity, P is the price index, which can be inflation or deflation, and Y is real GDP. So real GDP times inflation is nominal GDP. So that's what the PY is. Money supply times velocity equals nominal GDP. So how much money is there? How much is it turning over? That equals nominal GDP. But each side of the equation has two parts. So Friedman said, well, mature industrialized economy like the United States can only grow about 3.5% in real terms. That's about right. I mean, you can debate it, but that's about right. The only time we grow more is coming out of a recession when you have unused capacity. So let's just say 3.5%. Friedman said we want P to be one. If P is one, that means no inflation, no deflation. P equals one equals price stability. In other words, nominal GDP equals real GDP. There's no inflation or deflation. Then he went over to the other side of the equation and he said V is constant. So we'll treat M like a thermostat. We can dial it up or dial it down. And if we dial it up, we'll try to get real GDP to 3.5% and then stop because we don't want inflation, or dial it down if the economy is getting too hot. Almost like you have a dashboard and you control things. What's wrong with that theory? By the way, the equation is true. Irving Fisher, understood it, and Anna Schwartz and a few others understood it. Not very many people, by the way. What's wrong with Friedman's approach is that velocity is not constant. Now, it was from 1950 to 1980 during the main part of Friedman's career. It was pretty flat, pretty constant. So his assumption was not a bad pragmatic working assumption, but it's not true in theory. The truth is velocity can go way up or way down. So your thermostat idea completely falls down because you're controlling one variable, but you're not controlling the other variable. The problem with velocity is behavioral. It's not about money supply. It's not about so-called printing. It's not about fiscal policy or anything else. It's about psychology. And this is where inflation can run away. You can actually hold the money supply constant. Just say, hey, we're not going to print any more money. Make that constant. But if you double or triple velocity, you're going to blow nominal GDP through the roof, and you're going to be into inflation before you know it. So inflation is a risk. It's a real danger, but it doesn't come from the Fed. It doesn't come from Fed money printing or M0. And it wouldn't even come from fiscal policy unless there was a change in psychology. So that's what you actually have to look for if you're worried about inflation.
Jim Rickards' core message is simple. Successful investing isn't about reacting to every headline. It's about understanding market cycles and staying disciplined. While no one can predict the future with certainty, he believes investors who focus on long-term fundamentals rather than short-term fear are better positioned to navigate market volatility. If you enjoyed this analysis, please hit the like button, subscribe to the channel, and turn on notifications for more updates on gold, silver, the global economy, and the biggest interviews shaping the precious metals market. Now we'd love to hear from you. Do you think this correction is creating a long-term opportunity for gold and silver investors, or do you expect more downside before the next major move? Share your thoughts in the comments below. Thanks for watching, and we'll see you in the next video.